Welcome to the Techno Fundamental Report for July 25th. Earnings season. We're in the middle of earnings season. Now, let's think about the earnings reports. Now, these are report cards that come out once every 90 days that reflect on three factors. One would be how much did the revenues go up for the quarter? How much did the net income or the earnings go up for the quarter? But really, most importantly, management tends to make announcements about future quarters or the rest of the year type of announcements. So all three of these factors have to be positive in order to get a good reaction. So it isn't the news that you should pay attention to, meaning the earnings report. It's how does the stock react to the news. Now, we saw yesterday, for example, Tesla announced, and the stock is down dramatically. It dropped about 12%. Google announced. So this has not been exactly a wonderful earnings season for some companies. It's a real mixed bag. Now, one of the points that I wanted to make here by Gerald Loeb, he says, accepting losses is the most important single investment device to ensure the safety of capital. You take small losses when you're wrong, and I think the key to it is, and this is something Jesse Livermore talks a lot about, you're only going to be right on so many of your investment decisions. And if you realize that you're wrong on one and you have a small loss in it, quickly get out and then just preserve your capital. It's all about safety of capital. When you're wrong, and there's just not much you can do about it. Now, Jesse Livermore would say, always sell what shows you a loss and keep what shows you a profit. In other words, let your winners run. When you are right and you're in the right kind of market and the timing is good, stick with it. Don't be anxious to sell. William O'Neill says, the whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount possible when you're wrong. So again, same concept. Peter Lynch says, selling your winners and holding your losers is like cutting the flowers and watering the weeds. This is very good advice. I would say the most important thing is to have a stop loss, whether it's a percentage, a certain amount of points, time. There are many ways to set a stop loss. So I put down here an old stock that, I'm going back to 2015, 2016 on a company called Fuel Cell. The stock got up to $370 a share, and it's now down to about $5 a share. You needed to realize quickly you were wrong on this, and you needed to take a small loss versus a catastrophic loss. I mean, that's 90%. You just can't do that. Now, here's another example. This is a recent situation. We all heard about the CrowdStrike situation where they had a upgrade to their software. It caused a major international shutdown of Windows computer systems. Let me show you how I have this set up here. First of all, we have the trend meter at the top here. You want to stay in stocks that are in uptrend, and there's a couple of reasons for that. Now you can see here I have the 10-day moving average, I have a 21-day moving average, a 50-day moving average, and a 200-day moving average. One of the ways that I would review this, and I would review this daily, you get a break below these moving averages here, and so that's what we call a break. And then you would get a violation where it crosses below the low of the break, and then you get what you call a violation. So you would have exited this stock, around 360. Well, it's on the way down to 258, and it's broken the 200-day moving average. Now, the other problem here is you now have a problem called overhead supply of sellers, which means that every time this stock tries to rally, these people want their money back. So the stock rallies and so forth. Now, I'm a portfolio manager. I know this because I do it. In other words, if I make a mistake, and I get a chance to get back out even, I'm going to do it. So basically, that's just to be aware of overhead supply. It could really keep a lid on this stock for years, if not, decades. Now let's take a look at the market. Now, again, let me show you how I'm setting this up. I have the trend meter at the top. I have the 10-day, 21-day, and 50-day. Now this is the NASDAQ. You can see here we are getting a violation here on the NASDAQ, and the trend meter has moved into the yellow. I would say that this is an indication to get cautious. Mid caps, however, and this is really what may be going on here, we're seeing some rotation out of the big, large cap, Magnificent Seven tech stocks, and we're starting to see improvement in the smaller companies. So this is the mid cap stocks. Really no violation here, but we do have a break of the 10-day, but no violation. So that's one positive. And then we have here, we have the, the New York Stock Exchange. Again, these are all the stocks on the New York Stock Exchange. You got a top, you got a break below the 10-day, and now you're kind of breaking below the 21-day. So again, it indicates you should be probably sitting on some cash right now. Small caps, you can see the difference here. Now we have, for the last, I would say, couple of years, we have watched these small caps underperform. They have really not done anything. Well, these stocks tend to be, and the S&P 600 is different than the Russell 2000. This is a higher quality group of small caps. And they're very sensitive to interest rates because most of these companies depend on debt financing for their balance sheet. So you can see here, maybe we're starting to see a possibility that we're going to see some Fed rate cuts, and that's holding this group up. Now here's the S&P. You can see here on the Standard & Poor's 500, we got the break, and now we're getting the violation. So again, like the NASDAQ, the large cap stocks are now starting to act weak. Now here's the equal weighted S&P. This is where the stocks are not market cap weighted. Everything is weighted the same. So again, like the small caps, it's holding up the best. Now let's just take a look at some stocks. Now I will say this, I don't like looking at negative charts because I want to maintain my chart eye for positive patterns. So what we're going to look at here is just a group of stocks. These are not buys, they're not even on my watch list. I just think it's interesting to point out that some of these stocks are really starting to break down. So this is Amazon. We all know about Amazon, very popular stock in a lot of mutual funds. You can see here we've gotten not only a break of the 10, the 21, and the 50. So we're breaking down here. Now, if it breaks down into here, that's going to be troubling. But also, again, the overhead supply problem could take a while to get this stock moving again. We'll see. Microsoft, another big name. You can see here the same problem. We've got the breakdown. We've got the trend meter moving into the yellow. It dropped yesterday on pretty heavy volume. And also I've got relative strength down here. I got two relative strengths. And you can see in both cases we're really not doing all that well. Here's Netflix. Again, another one of these popular large cap stocks that is somewhat broken down and breaking down below that 50-day. Here we have NVIDIA, very popular. It's down pretty good this morning. You know, we get down into this area here, and again, you've got a lot of people. See, with NVIDIA, I've been very concerned that this AI thing has been somewhat of a bubble. People that have come up to me that normally don't invest in the stock market and are telling me that they're buying NVIDIA. And they did split the stock, which is not a good sign. I mean, that's just another issue. Here we have the VanEck Vector Semiconductor ETF, and you can see here the semiconductors as a group are somewhat breaking down. So in conclusion, what the bottom line here is that we've entered a period here where the market is starting to have difficulties. I would kind of hold off any new buying right now, and I would continue to hold cash and stay conservative. So thank you very much. If you have any questions, please let me know.